Let's get more on this story with Danny Moses, the founder of Moses Ventures and of Big Short fame. He's also the co-host of the On the Tape podcast, which you want to catch. It also stars our friends Dan and Guy. Danny, great to see you.
Great to see you guys.
Do you agree with Dan in that you think people are being a little bit too complacent? I mean, from the morning on throughout the day, the line has been looking at this, and it doesn't seem to be systemic at all, and it doesn't seem to have any ripple effects, and it seems to be just an Archegos capital problem.
I don't know if it's systemic or not. I do think you could connect the dots here a little bit. I go to what really caused the margin call, so to speak. It wasn't these stocks dropping dramatically. Was it something else that caused the stocks to drop that created the margin call? I was watching the Greensill story unfold, and if you remember, Credit Suisse is on the hook for potentially billions of dollars. And I think they had an entire review go on in their system over the last couple of weeks. I think part of that review may have been, are we valuing our risk correctly across all parts of our business? And we know that they had exposure to this fund. We know it was probably at least 5 times leverage. We don't know the exact dollar amount, but you can imagine if they made the call internally to say, you know what, guys, take risks down across the board, it could have caused this, and the ripple effect occurred. And there's several counterparties here. I don't know if there's more copycat funds that are out there potentially. I'm just happy they can't blame short sellers this time for it, but we'll see. I think this thing's going to play out over the next few days.
Danny, it's Karen. Thanks for coming on. Let me ask you, when you think about the risk of the banks that do these kind of financings, do you think of Credit Suisse and maybe Nomura in one category of risk and maybe Morgan Stanley and Goldman and JP Morgan in another, or do you think they're all taking the same kind of risk?
It's hard to tell. It's probably client to client. I would think that you get some of these more exotic trades on some of these European banks, foreign banks. The U.S. banks, I think, are very careful cosmetically to not look bad to the regulators, because we all know what happens when something like this occurs. There'll be a hearing now next week, that's going to go on down in Washington. But, it's just amazing to me. Leverage is always the root of all blowups. In the history of Wall Street, it's always been leverage. And to allow leverage to this fund, to this particular person who had an insider trading issue back 10 years ago, who was known to actually manipulate stocks lower back then when he was shorting Chinese banks, now what appears to be probably manipulating stocks higher, I'm sure. And there's probably other stocks that we haven't heard about that he was probably involved in. But I think to that end, I think that the risk controls just on the margin, no pun intended, are better at the bigger U.S. banks and some of these U.S. subsidiaries of the European and other Asian banks that are out there. If you look back to the time that there was the issue with CDOs and CDS, a lot of it fell on the French banks, the Spanish banks. Yes, of course, the U.S. banks were in the middle of it, but a lot of the deep leverage, a lot of the increased leverage was on the foreign banks at the time. They were just less regulated at the time.
Hey, so Danny, you just mentioned you've been tracking the Greensill situation. You and I talked about it earlier this month. And then now we see the situation with leverage coming undone in a multi-strat fund. You take these two events just happening in 1 month here, and take me back to 2007 when you were obviously, prominently featured in The Big Short here. Some of the stuff that you were digging around as far as the housing market was concerned and the esoteric products that were built on top of those loans. Could it be that these situations are just one-offs here? Because I remember 2007, and I remember when the first CDO blew up, and I remember a lot of people saying that you don't understand it, this is a one-off thing. Well, it ended up being the thing that almost took down the financial markets globally here. Are there any threads here that we can connect that you might kind of like remind you of 2007 and the lead up to 2008?
Sure. I guess as it relates to Greensill in particular, there is a lot of relevant comparisons. They were offering, quote, money market type of returns for what was an insured product of supply chain financing. And so with that, they marketed $10 billion to their high net worth clients to say, hey, instead of getting, I guess in Europe, negative returns, let's get 1%, 2%, 3% on these funds. Tokio Marine was the insurance company for it. If that sounds familiar, let's think about MBIA, AMBAC, and AIG insuring CDOs at the time, where money market funds in the U.S. globally were actually had these subprime mortgages and CDOs in them. Everybody, quote, thought they were safe, AAA rated, et cetera. So that is similar. Being able to have those type of products out there that are accessible to what people think is safe is the same. As it relates to this particular deal with this hedge fund or this family office, I think it is somewhat contained. But again, Wall Street is the enabler that gives the leverage to the system and allows people to blow themselves up. And that will never change. It doesn't matter if it's long-term capital, or if it's this. So that is the one continuous thing that is the same.
Danny, always great to get your thoughts. Thank you.
Thank you, guys.
Danny Moses. Tim, for a brief moment in time here, there is going to be a focus on CFDs, as well as swaps. And so what do you think would be the most constructive outcome of this in terms of things to look at, things to examine and take a hard look at?
Well, I think leverage in the system is really what this comes down to. And let's be clear, these assets that were underlying the swaps are not difficult to value. They're easy to value. They're publicly traded. They're very liquid companies for the most part, as opposed to esoteric CDS, CDOs on assets that were made to look AAA when in fact they were junk. So I worry about an environment where liquidity is free. These things happen when nobody's watching and when in fact the system's been pumped up with liquidity. Are there people over their skis right now? You betcha. Have market conditions changed in the last 3 weeks? Noticeably. I mean, look how the SPAC market's dried up. Look at a lot of the high multiple stuff. Square's about to trade below 200. Look at what's happened to high multiple tech. That's the stuff investors should be worried about. I think we haven't solved derivatives and their potential risk to capital markets overall. But it's a very different world, and the bank balance sheets are very different than they were in 2008.
All right. Let's get to today's market action now. The Dow closing at a new all-time high. S&P and NASDAQ both finishing in the red. But check out the Russell 2000. This really stood out, fell nearly 3%, now down nearly 5% over the past week. Of course, for the year, it is the outperformer of these indices, Guy. But what do you think of this move here, this continued move lower?
It's interesting. You asked me last week, about seemingly what's going on with COVID and what's happening in Europe, some of the states here in the United States. Then you heard some of the comments out of the CDC today. Maybe it's all playing into the Russell specifically and the broader market's not paying attention. But clearly the IWM has not traded well since, I want to say the last 2.5 weeks or so. It's been pretty much a straight line lower, albeit for a bounce. I think it's telling that story that maybe the reopened trade is not as robust as the IWM was saying a month or so ago. And oh, by the way, I throw this one as well. 10-year yields back above 170. I think there was a point where the Russell loved rising yields. I think we're at a point now where it doesn't. So I think those two things are playing in right now.
Yeah. Dan, your take?
Yeah, I do think it's interesting that the NASDAQ is also in a very clear downtrend. And so, the Russell, because of that outperformance, Mel, that you just mentioned, is going to be a bit more volatile here. It hasn't broken that low from earlier in the month. I think you keep an eye on that here. But I do think that there's air to come out of the Russell 2000, especially when you consider the outperformance from energy and some financials there. And I'm just going to go back to financials. You can't tell me that the XLF, where it is just a few percent from these 10-year highs or something, is incorporating all the risks that we've seen in these two crises. I don't believe that they are contained to these two situations. These banks have a lot of risk in a lot of different ways. And Tim makes a point. They are not CDOs. I get that, but they are interconnected. On the other side of each one of these swaps is another big bank. We just had two small players here in this one, and I don't know why this unwound happened, but I suspect there's more to come.
Before we go, I want to quickly go to Karen as the other bank shareholder on the panel. Karen, how do you counter what Dan says? Because presumably you haven't changed your positions.
Right. No, I'm still long banks. I mean, normally in a day like today where we see the 2s, 10s get wider and, rates go up, that's normally been a good thing. However, we don't know the magnitude of the losses for the capital markets groups of whomever is involved here, Goldman Sachs, JP. I mean, they're all probably involved in some way or another, but that is a little bit disappointing for sure, that we've seen that, I don't know, every several years we see something like this. I am actually optimistic that the losses will not be significant here for the Morgan Stanleys, JP Morgans, Goldman Sachs of the world.
Shepard Smith here. Thanks for watching CNBC on YouTube.